The US just passed a bill that adds $3.3 trillion to the national debt on top of a deficit already 63% higher than the 50-year average. The markets are twitchy, the dollar is slipping, and if this continues, millions could see their savings, homes, and retirements vanish. The bomb that's ticking. America's debt spiral isn't coming, it's here. The federal deficit has blown past 6% of GDP. Not during a war, not after a recession, just because. And that should scare you more than any headline about inflation or Wall Street losses. Independent studies from Yale, the Wharton School, and the Congressional Budget Office all agree. President Donald Trump's budget plan will pile on trillions more over the next decade. Wall Street titans are sounding the alarm. Ray Dalio says the US is showing classic signs of a late-stage debt cycle and gives it a 50% chance of crisis in the next 3 years. At PIMCO, Chief Investment Officer Dan Iveson is quietly shifting billions away from treasuries. Why? Because the world's safest asset is no longer so safe. If the dollar crashes, if global investors stop buying US debt, everything changes. Rates skyrocket. Mortgage payments double. The markets plunge. Retirement accounts bleed. And the Fed? Their hands are tied. The spending that lit the fuse. Recently, Congress passed what it called the One Big Beautiful Bill. But the beauty ends there. This bill adds $3.3 trillion in new debt over 10 years, according to the Congressional Budget Office. That's on top of existing annual deficits already breaching $1.7 trillion. And here's the twist, this is happening during peacetime, in a growing economy, which means the US is throwing fuel on the fire voluntarily. For perspective, the US deficit now exceeds 6% of GDP, compared to a long-term average closer to 3.7%. And unlike past debt spikes that were temporary like World War II or the 2008 financial crash, this one has no off-ramp. Why investors are getting nervous? You might think, well, hasn't the US always carried debt? Sure, but something has changed. Over the past 6 months, the value of the US dollar has dropped, signaling that foreign investors are losing appetite for American debt. This isn't a theory, it's happening in real time. Look at the Treasury market, the most stable corner of global finance. It's acting erratic, with unpredictable movements that suggest deep investor anxiety. And while markets haven't yet panicked, insiders like Ed Yardeni, the economist who coined the term bond vigilantes, warn that the trigger could come anytime. The vigilantes are real. They don't care about politics, they care about numbers. And when those numbers get scary, they sell. That's when yields spike. That's when borrowing gets expensive. That's when the house of cards collapses. Inflation, interest rates, and the cost of debt. Here's where this gets personal. As debt grows, the government pays more in interest. And it's not chump change. Today, interest payments alone on US debt are approaching $1 trillion per year. That's more than we spend on Medicare. Soon, it could surpass defense. Maya Maguinias, head of the Committee for a Responsible Federal Budget, warns that this shifts the entire federal budget. Instead of investing in schools, infrastructure, or science, we'll be writing checks to lenders, many of them in China and Japan. It also means the government is less able to respond when a real crisis hits. If another COVID-level event happens, the US won't have the financial firepower to act fast. And inflation, it stays sticky, because to fight inflation, the Fed needs to raise interest rates. But when you're drowning in debt, high interest rates just accelerate the collapse. The 2020 preview. We've seen this movie before. In March 2020, as the pandemic spread, investors rushed to sell treasuries to raise cash. But dealer banks like Goldman Sachs and Morgan Stanley couldn't keep up. The market nearly froze. The only thing that saved it? The Federal Reserve. The Fed stepped in and bought billions of dollars in treasuries, stabilizing the market and injecting liquidity. But that was during an emergency when inflation was low and aggressive money printing made sense. Today, that playbook won't work. With inflation still elevated, if the Fed floods the system with dollars again, it could ignite runaway inflation hurting savers, retirees, and the middle class. Worse, it could look like the Fed is financing government overspending, which could tank global confidence in the dollar, the national security risk no one talks about. There's another layer to this crisis: national defense. Admiral Mike Mullen, former chairman of the Joint Chiefs of Staff, once called the national debt the greatest threat to US security. Why? Because the higher the debt, the more gets spent on interest, and less is left for the military. Historian Niall Ferguson backs him up. He points out that every great power that ended up spending more on interest than on defense eventually declined. And according to Ferguson, the US crossed that red line last year. So yes, the debt isn't just a financial risk, it's a geopolitical one. And the longer we ignore it, the more leverage we hand to rivals like China, who already hold over $800 billion in US treasuries. The Fed's quiet panic. Behind closed doors, the Fed is already moving. Just last week, they proposed loosening the supplementary leverage ratio A rule that controls how much cash banks must keep on hand. Why? Because they want big banks to hold more treasuries. If there's another sell-off, the Fed doesn't want to be the only buyer in town. But this is a stopgap, not a solution. The Fed can adjust rules, it can create clearinghouses, but it cannot fix Congress's addiction to debt. How long do we have? The Penn-Wharton budget model estimates that the US has less than 20 years to course correct. After that, even massive tax hikes or spending cuts may not be enough to avoid default or something that feels like it. Can the US print its way out? Technically, yes, but that triggers hyperinflation. Think, your savings losing value by the day, gas at $12 a gallon, milk at $15, and global investors fleeing the dollar like it's toxic. That's not a solution, that's collapse. As Robert Rubin, former Treasury Secretary, put it, we may be entering uncharted territory, and it's happening right in front of us. America's debt spiral is no longer an abstract number on a government spreadsheet. It's becoming a threat to markets, everyday families, national defense, and global stability. The fuse is already lit, and if we keep pretending this is someone else's problem, we're all going to feel the explosion. It's time to pay attention, because the next crisis, it might not come from war, or oil, or Wall Street. It might come from within.